Welcome to The Explainer. You ever look at a stock chart and just see a bunch of squiggly lines? Well, today we're going to decode that language. We're talking about the philosophy behind technical analysis, the art of reading what those charts are really trying to tell us.
So let's get right to it. The big question, the one that's kept investors up at night for, well, forever. Can you actually predict what the market's going to do? Is there a method to all that madness, or is it just a totally random mess? That's the puzzle we're tackling today.
When it comes to figuring this out, investors basically fall into two big camps. First, you've got your fundamental analysts. Think of them like detectives. They're all about the why. They're digging through balance sheets, earnings reports, the whole shebang, trying to figure out what a company is truly worth. Then you've got the technical analysts. They say, forget the why, just look at the what. For them, everything you need to know is right there in the price action on the chart.
Now, it's not that technical analysts, or technicians as they're called, don't care about the fundamentals. It's more that they believe all that why stuff is already baked into the price. Their whole world, their entire philosophy, really rests on just three core ideas. Okay, premise number one, and this one is the big kahuna, the absolute cornerstone of their thinking. The market discounts everything. What does that mean? It means that everything, every piece of news, every earnings report, every political drama, every bit of investor fear or greed is already reflected right now in the stock's price. So for a technician, the chart isn't just a picture, it's the whole story.
All right, number two, prices move in trends. This is basically Newton's first law of motion, but for markets. An object in motion stays in motion, right? Well, a price trending up is probably going to keep trending up. A price trending down, well, you get the idea. The whole game for a technician is to spot a trend early, hop on, and ride it for as long as possible. And finally, the third belief, history repeats itself. Why? Because we repeat ourselves. This part is pure human psychology. Those patterns you see on a chart, technicians believe they're just pictures of our collective fear and greed playing out over and over again. And since people don't really change, we get greedy, we get scared. The theory is that these patterns will keep working, time and time again.
Okay, so we've got these three big ideas. But how do you go from philosophy to actually, doing something with it? If you believe prices move in trends, how do you see them? Well, it's all about learning to read the market's tides, and that starts with a couple of key building blocks. And look, I can't stress this enough. The idea of a trend is everything. The famous technical analyst John Murphy basically said that without trends, the whole field just collapses. It's the foundation that everything else is built on. Seriously.
So how do these trends actually form? It all comes down to two concepts, support and resistance. Just think of it like this. Support is a floor. It's a price level where buyers step in and say, nope, it's not going any lower, this is a good deal. And resistance? That's the ceiling. It's where sellers take over and say, okay, that's high enough, time to sell, and they stop the price from going up.
And this is where the psychology gets really cool. When a price breaks through a floor or a ceiling, something amazing happens. They often switch roles. That old support floor can become the new resistance ceiling. Why? Just imagine all the people who bought at that floor. The price drops, and they're sitting on a loss. All they want is to get their money back. So if the price climbs back up to where they bought in, what do? They sell. Bam! That old floor of buyers just turned into a new ceiling of desperate sellers. And once you get that, you can start to see how a trend is born. See, an uptrend isn't just a straight line going up. It's more like it's climbing a staircase. It goes up, takes a little breather, then goes up again. You get a series of higher highs and higher lows. Each dip finds support at a higher floor than the last one. That beautiful, rhythmic, step-by-step movement, that's the heartbeat of a healthy market. All right, so you've got this constant battle between buyers and sellers creating floors and ceilings. Over time, these battles start to draw recognizable shapes on the chart. Technicians call these patterns, and they're basically pictures of crowd psychology in action.
And let's be clear, this isn't magic or voodoo. A chart pattern is just a visual story. It's a record of the fight between the buyers, the bulls, and the sellers, the bears. It shows you, right there on the screen, who's winning, who's losing, and when the tide might be about to turn. So to make this real, let's look at a classic, maybe the most famous pattern of them all, the head and shoulders top. When technicians see this shape forming, alarm bells start going off, because it's often a sign that a big, strong uptrend is about to die and reverse.
So here's the story the pattern tells. First, you get a strong rally. That's the left shoulder. Then, another rally that pushes even higher. That's the head. But here's the catch. It usually happens on less trading volume.
The enthusiasm is fading. Then you get one last, weaker rally, the right shoulder, an even lighter volume. The buyers are exhausted. The final nail in the coffin is when the price breaks below the neckline, that support level holding the whole thing up. That's the signal.
And I gotta say it again, pay attention to the volume. Volume is like the exclamation point on the chart. A price breaking a level is interesting, but a price breaking a level with a huge surge in volume, that's the market shouting, not whispering. It shows real conviction that a lot of people are putting their money where their mouth is.
Okay, so we've got trends, patterns, volume. It sounds like a system for predicting the future, right? A crystal ball? Absolutely not. And that brings us to maybe the single most important thing to understand about technical analysis.
Any pro will tell you this isn't about being certain. It's not a prediction machine. It's a framework for managing probabilities. It's about risk management. The whole point is to use these tools to find spots where the odds are stacked in your favor, where your potential reward for being right is way, way bigger than your potential loss if you're wrong.
So look, if you forget everything else, remember this one thing. Technical analysis, at its core, is just applied psychology. You're not really studying charts, you're studying people. You're studying the patterns of mass human emotion, fear, greed, hope, as they get recorded second by second in the price of a stock.
And that brings us full circle, right back to where we started. So what do you think? Are those squiggles on a chart just random noise? Or are they something more? Are they the footprints left behind by the crowd, showing us predictable patterns of human nature that just keep playing out again and again? That's the million-dollar question, and technical analysis is one way of trying to answer it.